Welcome to the deep dive. Today we're tackling FX currency swaps. You've shared some really great sources to help us understand how these agreements work.
Yeah, and why they matter so much in, international finance.
Exactly. Our goal here is to really break this down for you, get into the core mechanics, maybe some surprising uses without getting lost in the jargon.
Absolutely. We've got material covering the basics, the applications, market role, risks. Pretty comprehensive. It's key stuff for understanding how global money moves.
And speaking of surprising uses, here's a nugget for you. Did you know these swaps can actually help companies borrow money cheaper internationally than, say, going straight to a foreign bank?
It seems counterintuitive, doesn't it?
Uh,
But yeah, we can explore how that works. It really shows how these tools optimize finance across borders.
So for this deep dive, the plan is start with what they are, walk through how a deal gets done, look at why companies and even central banks use them.
Cover the key terms, some real-world examples too.
Right. And touch on the risks, definitely. Then maybe compare them quickly to other financial tools you might have heard of. Okay, let's dive in. What exactly is an FX currency swap?
So basically, it's an agreement. Two parties agree to swap principal amounts and order interest payments. Crucially, these are in different currencies, and it happens over a set time.
Okay.
Think of it as a structured way to manage different currency needs or risks. You see multinational companies, banks, and even central banks using them quite a bit.
And I hear currency swap and cross-currency swap. Are they the same thing?
Often used interchangeably, yeah. Technically, cross-currency might more explicitly include swaps involving floating rates, but the core idea is the same, dealing with multiple currencies.
Got it. And you mentioned rates. Are there different types based on those?
Oh, definitely. There's fixed for fixed, which is predictable, good for long-term planning.
Stable. Right.
Then fixed for floating. One side gets certainty, the other's payments move with market rates, like SOFR, or maybe older ones linked to LIBOR.
Interesting. What else?
Floating for floating, sometimes called basis swaps, that's more about managing differences between floating rate benchmarks in different currencies. You see that in the interbank market.
Okay.
There are also zero coupon swaps. One side pays regularly, the other pays a lump sum at the very end. Useful if, say, a project only generates cash later on.
Right. Aligns the cash flows.
Exactly. And finally, amortizing or accreting swaps, where the main amount, the notional principal, changes over time, maybe matching an underlying loan that's being paid down.
Okay. Quite a few options there. So walk us through a typical transaction. How does it actually happen?
Well, it starts with the agreement, obviously. You nail down the currencies, the amounts, the notional principal, which is key for calculating interest, but isn't always swapped up front. Then the exchange rate for the start, the interest rates involved fixed, floating the duration, how often payments happen, often uses a standard contract, like an ISDA master agreement.
The framework.
Yeah. Then, usually, there's an initial exchange of the principal amounts at the agreed spot rate.
Okay, money changes hands.
Then come the interest payments,
Yeah.
periodically, based on the rates agreed for each currency. Importantly, these aren't netted out because they're in different currencies.
Okay.
And finally, at maturity, the end date, the principal amounts are swapped back, often at the original exchange rate, which removes exchange rate risk on the principal. Then it's all settled.
So why go through all this? What are the main reasons, the big drivers for using these?
Hedging currency risk is a huge one. Locking in exchange rates gives companies predictability for international business.
Makes sense.
Managing interest rate exposure across currencies is another. Maybe you borrowed fixed but want floating, or vice versa, in a foreign currency context.
And the cheaper borrowing cost you mentioned?
Yes, that's a big draw. A company might borrow cheaply, where they're well-known, say in USD, and then swap into euros if they need euros, potentially getting a better effective rate than borrowing euros directly. It also gives indirect access to foreign capital markets. And for central banks, think swap lines providing foreign currency liquidity to their domestic banks, especially during crises. Very important tool.
Fascinating. You mentioned notional amounts and spot rates.
Yeah.
Any other key terms we should quickly define?
Yeah. The forward exchange rate is important. That's the rate agreed for a future exchange, and it reflects interest rate differences between the currencies.
Okay.
Obviously, the interest rates themselves, fixed or floating, linked to benchmarks like SOFR or Euribor. The maturity date or tenor, just how long the swap lasts, and the payment schedules, how often interest gets paid.
Can you give us a quick example or two, make it a bit more concrete?
Sure. Think of a U.S. company setting up in Germany. They might borrow USD cheaply at home, then swap into EUR to pay for their German factory or operations, hedges their costs. potentially cheaper overall.
Right?
Or the classic early one, the World Bank IBM swap back in '81.
Right.
They essentially traded IBM's need for Deutschmarks and Swiss francs for the World Bank's need for US dollars.
Landmark deal.
Yeah. More recently, you see exporters like Samsung Heavy Industries hedging big contracts denominated in foreign currency.
Yeah.
And like we said, central banks, the Fed, used swap lines heavily in 2008 and more recently too.
Seems powerful, but surely there are risks involved.
Absolutely. Counterparty credit risk is the big one. What if the other side defaults?
Mhm.
You mitigate that with credit checks, collateral agreements, sometimes central clearing.
Okay. What else?
Market risks are always there. Exchange rates moving against you, interest rates changing unfavorably. Liquidity risk, it might be hard to get out of a swap early if you need to, especially for less common currencies.
Hmm.
And operational risk, just errors in paperwork, settlement. Also basis risk, if you're in a floating for floating swap, the benchmarks might not move perfectly together.
So despite those risks, they clearly play a major role globally.
Oh, massively.
Yeah.
They make markets more efficient, help capital flow where it's needed, help transfer risk. They aid in price discovery for currencies and rates.
Crisis.
Yeah, the trading activity itself helps reveal what the market thinks rates and currencies should be worth. The volume, especially with the US dollar, is huge, essential for global trade, investment, and, like we keep saying, a key tool for central banks managing stability.
How do these compare to, say, just a simple FX swap or a forward contract? People might know those.
Good question. So a basic FX swap is usually shorter term, maybe under a year. It's really a simultaneous spot buy-sell and a forward sell-buy, mostly for managing short-term cash flow or liquidity, usually no ongoing interest payments like in a currency swap.
Right. Simpler.
An interest rate swap is different too, that's swapping interest payments, but in the same currency.
Yep.
No principal exchange usually,
Yeah.
just managing interest rate views.
Okay.
An FX forward is just a single agreement to exchange currencies at a future date at a set rate, hedging or speculation. And an FX option gives the right, not the obligation, to exchange.
Right.
So currency swaps are distinct with their longer-term exchange of principal and periodic interest payments across currencies.
Okay, this has been a really helpful deep dive. If there's one key takeaway for you, our listener, what would it be?
I think the core idea is transformation. These swaps let you transform financial obligations, debts, revenues from one currency to another. There's sophisticated tools for managing risk, yeah, but also for finding cost savings and accessing markets. They're really a fundamental piece of the global financial plumbing, maybe one you hadn't thought much about.
Right, and it makes you think, doesn't it? With economies so linked and currencies always moving, how might, say, an event in one country ripple through the swap market? It could affect businesses, maybe even your own investments, in ways that aren't immediately obvious. It just shows how interconnected it all is. Thanks for exploring this with us.